You occasionally may come up with a good reason to change your asset allocation. This should occur rarely. When I say that, I'm not talking every week or two, I'm talking once a decade or so. Remember, this is a strategic asset allocation we're talking about, and not a tactical one. You don't change it in response to security valuations or recent market events. You need to be very careful about performance chasing, which is a very natural tendency that most investors fall into. I suggest you give yourself a waiting period, perhaps even 3 to 6 months after deciding to change the asset allocation, before actually doing so. You may be surprised to see that after a 3 month wait, you no longer think that change was such a good idea. A few reasons why you might want to change your asset allocation include: 1, a decrease in risk. In general, as you get older, closer to retirement, and closer to your financial goals, you probably want to dial down the risk a bit with safer assets like bonds and less risky assets like stocks. You may want to decide now how you plan to do this, decreasing stocks by 1% a year or 10% a decade or whatever. You may also find you simply don't need to take as much risk after a raise, particularly strong market performance or an inheritance. Another reason is a change in life circumstances. Perhaps you get married and your spouse doesn't like you investing in microcap stocks, or you find you need a higher return than you originally anticipated. You may also gain access to different asset classes through a new 401k. Another reason is to add an asset class. Every now and then a new asset class comes along. If, after evaluating, you find you want to add it to your portfolio, it's okay to do so. I do recommend you be very careful about performance chasing, however. It's easy to do, even for the right reasons. And finally, buying into a new theory. You may come across some new investing research or theories that indicate a change in investing strategy. Examples from the past include the development of mutual funds, the development of index funds, the development of real estate investment trusts, three-factor analysis into the benefits of small and value stock investing, or even momentum investing.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.